The tension in the room is palpable as a jury delivers its verdict on June 15, 2002. Arthur Andersen, once a titan of accountancy, stands accused of obstructing justice. Silence envelops the courtroom. The words "guilty" echo like a death knell. Everything Enron built teeters on the brink, threatening to collapse into dust. What led to the fall of this corporate empire? And how did it reshape the world of business forever? In 1988, a new era dawns as Enron enters the UK energy market, constructing the Teesside power station. The company, founded by Kenneth Lay in 1985, is on a meteoric rise. Offices buzz with ambition, and the air is thick with the scent of opportunity. Enron is not just another energy company, it is a symbol of innovation and progress. By 1990, Enron becomes a natural gas market maker, venturing into the world of futures trading. The possibilities seem endless. For ordinary people, Enron represents the promise of a brighter future. Jobs flourish, and the economy hums with the energy of growth. Employees and investors alike are swept up in the excitement, their fortunes tied to Enron's soaring trajectory. The company is lauded as the most innovative large company in America, proof of its cutting-edge approach and relentless drive. But beneath the surface, the foundation begins to crack. Enron's aggressive accounting methods, including the misuse of mark-to-market accounting, lay the groundwork for future turmoil. Special purpose entities obscure the true financial picture, masking liabilities and exaggerating equity. The board of directors and audit committee remain unaware of the looming storm. As Enron's empire expands, the seeds of its downfall are quietly sown. The first whispers of trouble are in the air, hinting at the unraveling to come. The year is 1991. Enron, riding high on its reputation for innovation, makes a fateful decision. In a sleek Houston office, executives gather around a polished conference table. They adopt mark-to-market accounting practices. It's a bold move, one that promises to revolutionize how they report profits. But it's also a gamble, teetering on the edge of legality. The following year, Enron expands its empire. It acquires Transportadora de Gas del Sur, a strategic move that strengthens its grip on the global energy market. The acquisition is proof of Enron's aggressive growth strategy, a relentless push to dominate the industry. In 1993, Enron forms a joint venture with CalPERS, the California Public Employees Retirement System, called JEDI. This partnership is more than just a business deal. It's a symbol of Enron's growing influence and its ability to forge alliances with powerful institutions. The venture opens doors to new opportunities and further cements Enron's status as an industry leader. By 1997, Enron's reach extends into new territories. It acquires Portland General Electric, a move that solidifies its position in the utility sector. The acquisition is another feather in Enron's cap, showcasing its ability to diversify and adapt in a constantly changing market. That same year, Jeff Skilling, one of Enron's key architects, approaches CalPERS with a proposal for a separate investment. His vision is expansive, his ambition boundless. Enron's innovations continue to reshape the energy landscape. In 1998, the company begins selling natural gas to customers in Ohio and wind power in Iowa. These ventures highlight Enron's commitment to exploring new energy sources and expanding its customer base. The phones in Enron's offices ring incessantly as deals are struck and contracts signed. The excitement is palpable. The future seems limitless. Yet, beneath the surface, the cracks widen. The misuse of mark-to-market accounting and the creation of special-purpose entities cast long shadows over Enron's glowing success. These practices, initially seen as innovative, begin to reveal their darker implications. As Enron's empire reaches its zenith, the seeds of its eventual downfall are firmly planted. The horizon darkens, hinting at the storm that will challenge everything Enron has built. June 29, 2000. Inside Enron's bustling headquarters, tension fills the air. Executives finalize a deal with LJM2, a special purpose entity, to purchase Merrill Lynch's interest in barges. The price tag, $7,525,000. It's a calculated maneuver, part of a complex web designed to bolster Enron's financial statements. Promises are made, including a 22% return for Merrill Lynch. Yet beneath the surface, this transaction is one of many that blur the lines of legality. The year unfolds. Enron's aggressive accounting practices, including mark-to-market, continue to mask its true financial health. Profits appear inflated, liabilities hidden. The board remains in the dark, unaware of the high-risk tactics at play. Publicly, Enron thrives. Privately, it's a house of cards. March 2001 arrives, and with it, a crucial decision. Enron and Blockbuster Video withdraw from their contract. The venture, initially heralded as a breakthrough in video-on-demand technology, fails to deliver. The collapse of this partnership sends ripples through Enron's financial projections, but it's only the beginning of a larger unraveling. By November 2001, the storm that had been brewing finally breaks. Enron's stock price plummets to less than $1, a shocking fall from grace for a company once valued as a titan of industry. Panic spreads. Investors, employees, and executives alike face the harsh reality of Enron's financial deception. Within the walls of Enron, silence reigns. The phones, once buzzing with the promise of new deals, now echo with unanswered questions. The company, once seen as an unstoppable force, stands on the brink of collapse. The moment of no return has arrived, the tipping point where years of manipulation and fraud come crashing down. The largest bankruptcy filing in U.S. history looms, and Enron's fate hangs in the balance. The fallout will be felt far beyond the company's headquarters, setting the stage for profound changes in corporate governance and accounting practices. November 2004. Enron emerges from bankruptcy, a shadow of its former self. The corridors that once buzzed with energy now echo with emptiness. The largest bankruptcy in U.S. history, a staggering collapse, leaves a trail of financial ruin and shattered reputations. In a courtroom, tension mounts. Merrill Lynch executives stand trial, accused of aiding Enron's fraudulent accounting activities. The verdict: guilty. The conviction sends a clear message. No one is above the law. It's a decisive moment in the aftermath of Enron's downfall, a step toward accountability in a scandal that shook the corporate world. The numbers tell a grim story. Enron's recorded earnings, once manipulated to show $12 million, were a facade. The funds flow, purportedly $28 million, another illusion. The reality: billions lost in pensions and stock prices, leaving employees and investors devastated. The promises made to Merrill Lynch, a 22% return, now nothing more than a bitter reminder of deals steeped in deception. September 7, 2006. Enron sells its last remaining subsidiary, marking the end of an era. The final piece of a once mighty empire is gone. The corporate landscape has shifted, with Enron's fall serving as a cautionary tale of unchecked ambition and ethical compromise. The dust settles, but the impact lingers. The scandal prompts the enactment of the Sarbanes-Oxley Act of 2002, reshaping corporate governance and accounting practices. The dissolution of Arthur Andersen, Enron's accounting firm, shows the far-reaching consequences of the crisis. As the world moves on, the lessons of Enron remain etched in the annals of corporate history. The collapse, a catalyst for change, forces a reckoning within boardrooms across America. The story of Enron, a tale of hubris and fallibility, continues to resonate, influencing the future of business ethics and regulation. And beyond the horizon, new challenges await. In the aftermath of Enron's spectacular collapse, a profound shift echoes through corporate America. The scandal, a web of deceit spun from accounting loopholes and high-risk practices, exposes vulnerabilities in the very foundations of corporate governance. Enron's misuse of mark-to-market accounting, combined with its reliance on special-purpose entities, reveals how easily financial statements can be manipulated, masking true liabilities and inflating profits. This catastrophe acts as a wake-up call. The dissolution of Arthur Andersen, once a titan in accounting, shows the peril of compromised ethics. Enron's downfall becomes a catalyst, driving the enactment of the Sarbanes-Oxley Act of 2002. This legislation imposes stricter regulations, demanding transparency and accountability from corporations nationwide. The Enron saga serves as a cautionary tale, illustrating the dangers of unchecked ambition and ethical lapses. It reshapes the dialogue around corporate responsibility, urging businesses to prioritize integrity over short-term gains. As boardrooms grapple with these lessons, the legacy of Enron persists, a stark reminder of what happens when ambition overshadows ethics. Yet, just beyond the horizon, new challenges await. The year is 2001. Enron's stock price plummets to less than $1, a stark contrast to its once glorious valuation. Inside the hushed boardrooms, the truth unravels. Institutionalized systematic accounting fraud and a web of deceit spun from mark-to-market accounting and special-purpose entities. Andrew Fastow, the architect of these financial illusions, is ousted. The fallout is swift and unforgiving. Arthur Andersen, Enron's auditor, crumbles under the weight of its complicity. The Sarbanes-Oxley Act of 2002 emerges, a legislative response to the chaos, demanding transparency and accountability. In the end, Enron's collapse reshapes corporate governance forever, and the world watches, vigilant for the next storm.